your reading of again, yeah, let me just add here investment asset. We're talking about capital budgeting. We have capital structure, which is the financing part. We have the capital budgeting, which is the investment part. And we have also the working capital management. So some of these, for instance, notes I can share those notes with you on OneNote. So um, I can share those notes with you on OneNote. So let me just go back again to my screen. Just give me all the time when I'm moving from one screen to another. Just give me a bit of a second to breathe out, to breathe in and breathe out, and also, just to move my cursor. And so that will be learning unit one. Not difficult. It's only a few pages. None of you should struggle. There is also questions on the role of the financial manager that you need to read to read through. Easy to read. You have also the financial planning and analysis, forecasting and budgeting. We just mentioned the capital budgeting, so forecasting and budgeting, quite an important side of it. And then you have the coordination and control. uh, you have the investment decision. Remember that we talked about the financing side of it, the investment side of it, and that's why a financial manager needs to ensure that the funds that he has received are managed properly and are invested into um, the best asset that will provide the best return. So you have a short term, a medium, and long term view of it. All right. So um, we have the cash management. So as you read through, this is quite an easy read. And so please go to your assignment one, which is available. If you do not yet have it, there should by now have been even another email, showing you how to access the material. So please go to assignment one and two, which should be available and which you should already start working on. So whatever question, as you read chapter one, read also a couple of times your assignment one. Read the questions and do the reading, so that when you are familiar with the questions of your assignment, when you are busy reading, you will be seeing the sections that are answering the questions. And then beside that, you need also to do extra research. You should know that by now. You're not a first year student, you're a second year student, and there is a difference between you and the first year student. And you need to understand that whatever sources that you are using, you need to reference it. Otherwise, it's plagiarism. Why is that? Is that the fact that you need to evidence that you are really learning. So for people who hate referencing, I feel quite sorry for them. It's because they just do not understand the simple principle, is that when you are referencing, you are getting more marks. In fact, the way that you get distinctions is because you have done the work, you have read from other sources, and you are evidencing that you've read from other sources. You are demonstrating that you are learning. So no instructor in the world or lecturer will ever ever withdraw or withhold marks from you if you are evidencing. So otherwise, you might have consulted quite a lot of sources. Let's say you consulted source A, B, C, and D, but unfortunately you refuse to reference those sources. You will get less mark. And even the even even the biggest problem of that is that you've been stealing the work of other people, and you will be processed for plagiarism, which is not quite smart. But when you are evidencing, you are getting more marks because it is the proof that you are presenting, the evidence that you are presenting to your instructor that you've done extra reading, and that's why you should be proud of evidencing, of referencing those work to say that I went. I engage myself into learning, and I'm demonstrating that I've been learning by referencing the works that I've consulted. So this is the best talk I can give you about plagiarism. I'll add some material concerning plagiarism and but what you need to understand, remember again, like in your first year, you have the module guide, very important. Go through the module guide and use the module guide as your best friend when you are writing an assignment and you need reference. Okay, so we have dividend decisions. As you know, as you will be reading, the dividend is what we pay out, what the company pays out to its shareholders or the investors. So there is dividends that is being paid out. In other words, it's the profits that is being distributed to the investors. So and the profit that is not distributed to the investors is called retained income or retained earning. I think I can use a good beautiful tool this side to show you that this is retained. I think a good highlight will be better. The retained earning. So there's uh, one portion of the profit that could be distributed as a reward, that could be distributed as a reward to investors or shareholders. So the company will give it to its investors, to its shareholders. And then there is also a portion that could be retained by the company. For what purpose? You will read here. It's because the any business that is a sensible business should be worried not only about profit making, but also about uh, um, shareholders' wealth maximization. So it is important to maximize the wealth of the the owners of the company. There is a little bit of a growth. There needs to be growth. Whatever business is out there should not just be worried about um, paying out paying out interest, paying out interest to investors, or paying out dividends to its owners. It should also be thinking about growing the business as such. So, and we have the risk management side of it, quite important, because before you begin any business, you need to take into account the risk. And there's quite a simple principle for all of you to understand, is that the more the risk that is taken, the more the return. So this is quite a financial principle to say that the business that will have the more risk, they will also have the more return. And the businesses that are less riskier also have quite a low return. So the more we're taking the risk, there is a risk, but it should be a calculated risk, as we love to say. And there's different type of risks you can read here. There's operational risk, there's strategic risk, there's financial risk. You have quite a good read here. And finally, the ethical consideration. There need to be ethical consideration of the financial management side. We don't want somebody who is embezzling the money of the company. So this should be dealt with. And then there is one of the most important thing also to understand is the agency relationship and problem. So there is an agency problem. And what is the agency problem? In a nutshell, as you've been reading, you should understand that on one side you have the owners of a company, but the owners of the company will hire a management in order to run the company for the benefit of the owners. And sometimes there is what we call uh, the owners of the company and the shareholders. uh, the the management should have at heart the best interest, but in real life it's not always like that, because and there will be also um, uh, an asymmetrical, if I can say, flow of information between the two groups. Sometimes the managers will not provide all the informations to the owners. You see, there is certain information that they will keep, and other information that they will make the owners of the company have. So that's and that's what, as you read, you will see this asymmetric information, quite important. And you need to understand that's where the problem begin, is that sometimes the managers of the company might not be acting in the best interest of the owners, and in that case, then we have a problem. All right, so that's where the problem lies. So quite easy to understand that part, and then we go into our um, learning unit 2. So for learning unit 1, it's quite an easy read if there is a particular concept or principle. As you can see, there is nothing, there is no calculation. This is just basically a small introduction into the module, and touching on key principles that you as a student need to understand. All right, but if any of those concepts you do not understand, please reach out, please send me an email just to let me know that you are struggling with one or the other principle. I can book for you consultation time so that we can go through some of the things that you're struggling with. But this should be easy. With regard to assignment, everything that touches on learning unit 1, you should be able to easily answer it. And then now it is now getting to the meat, actually, the real action, if I can call it, because here in this chapter there will be quite a few calculation, and uh, uh, quite a bit of concept that you need to understand here. So interpreting financial results. Sorry about that. Interpreting financial results. So as you can see, that we are going to touch on quite some important points. We have shrinkage here. We have the effect uh, um, of statement of profit and loss. This I call and comprehensive income item on net profits. All right. So what you just need to remember at this stage is this. This is quite important. The sales, the cost of sales. So you have seen this already through your accounting module, where you touch on multiple financial statement. One of those statement is the statement of a comprehensive income, or uh, um, you've touched on the balance sheet, that I'm pretty much sure, and you have touched also on the statement of uh, uh, income statement, what we call the income statement. Income statement. All right. So as you will be aware, for any business, you will have uh, sales most of the time. Okay, depending on if for any profit, if I can say for profit, let me not say any business, because you might have not not for profit organizations, but I am talking about any for profit organization. The most important source of income will be the sales, and I expect every one of you to know this. The most important will be sales. And and so if we talk about sales, obviously we will need a cost of sales, which will be um, what we have incurred in order for us to generate the sale. So this is quite important because it helps to make this come alive. So we have a cost of sales and we have sales. All right. So as you can see, there is a quite an important description that I want you all of you to read and to understand really what's the crux of these items, what's really the proper meaning. Because once you understand this again, especially if you've done a bit of accounting, you would say, well, I know about this, but you need now to understand it also within a broader financial perspective, not only an accounting perspective. And this read will show you also some of the nuances or the differences between somebody who's looking at financial matters only from an accounting perspective versus somebody who's looking at a more broader financial perspective of things. So I hope that will be quite clear to you. So we have the sales, and we understand that the most important source of income will be sales. And then and it's quite easy for us to understand that when we're talking about cost of sales, we're not talking about sales return. So let's say company A, people are buying from a particular company, and then let's let a good example would be, for instance, Takealot. When you've ordered something online and it has been delivered to you, and then you do not like the item and you wish to return the item, yes, basically what you do is you are returning the item. That is not cost of sales. Okay, cost of sales is basically what we are going to uh, incur somehow in order for us to generate the sales, and that is clearly explained to you here. You will see sales return, and as an example, we have we've made sales of 400,000 and there was a return of 10,000. What we have generated actually in sales, we're going to deduct from the 400,000 10,000, and we have 390,000 that has been generated in sales. Quite easy, no issue, quite a lot of examples. And as you can see here, there is also cost of sale. One of the way that we can increase our sales is by increasing the unit sales, and or the unit cell, the number of units we are selling. If the more we're selling, the more money we're making, the more sales we are generating, if I can say. And another way would be, if we are not increasing the number of items that we are selling, another way will be to increase the price. So either we increase the price per unit. Let's say we're going to generate more sales. If we sell 10 units, just for the sake of an example, 10 units, and the price is 10 rand. Well, as you can see, the total will be 100 rand, right? Pretty simple. But now, in order for us to increase sale, either we will need to increase the price. Let's say if we increase it at 15, the total will be 150 as a total. So we've increased our sales. We've increased our sales. Or what we could do, if we keep the price, let's say our clients are customers are price sensitive, then what we would need to do is to increase the number of units. Let's get to the 150 total sales, then we will need here to increase to 150 to 15 units times 10 will give us also 150. So if you love calculation, and you can see this is quite easy. Okay, so let's move to the cost of sales. And as you can see, in fact, I even say before we touch on the cost of sales, we need to familiarize ourselves with the concept of VAT. So you need to understand the concept of VAT. Obviously, VAT is the tax, it's the value added tax, it's what we pay, it's levied on indirectly on goods and services. And so any vendor out there become automatically an agent of the government in order to help the government to levy that that tax on goods, on goods and services consumed in the economy, right? So this is quite pretty simple, as you can see. So to know the actual, if a particular product is sold, right? I think I'm back. Right. Okay. So we have, and so to understand, we the gross profit that a company is making will be sales minus cost of sales. This is a ratio. It's quite important, and we will touch on the ratio as we going to be coming to the end of our tutorial session. So as you can see, as you're reading, understand that these are ratios that we use. For instance, we want to know how much gross profit a company has made. All right. So I'm going to go to a particular example. Uh, And before I get there, let me touch on some of those items from the income statement. So we have the cost of sales, we have the expenses. And expenses, as you can see here, it says operating expenses. So we have probably bought merchandise in order to resell that merchandise uh, with a markup. Let's say we bought it at 50 rand, but we are reselling it at 100 rand. And so the markup there, or the profit that we expect to collect is 100 minus 50, which gives us 50. So, but this is gross profit. There are other things that are also involved. Not only buying the item and reselling the item, we bought the item, that was the costs of sales, the cost, and we so the and you have the cost of an item, the cost of an item, and the price of an item. Cost, price minus cost. And so we have this markup that we added, that in order for us to generate a certain profit. So that's quite easy to understand. But there is also other expenses that are also involved. Let's say we are in a particular a building. We are renting a particular room in order for us to sell those items. And so the rental for that building will be an expense that we're going to be incurring. All right. So but we need to understand that there is a difference. And what is really an expense? An expense is a cost that we incur, that any business incurs, uh, uh, that is not expected to be recouped. And that's a beautiful word there, recouped. So we're not expecting, when we're paying rent, we're not expecting to get back our rent. So that should be, and you need to understand these items quite importantly. So they will be um, definitely uh, 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 operating expenses. And when we're looking at operating expenses, we're looking at marketing and selling expenses. And then we have general and administrative expenses. All right. Another word for operating expenses is overhead. So when you're looking, for instance, at wages and salary, that's an expense. When you're paying your wages and salary, you are not expecting to get it back. Is input VAT and output VAT an operating or administrative expense? Not at all. Insurance is an expense. When you're paying for your insurance, your car insurance, you are not expecting for the insurer to give you back money. So it's an expense that you are not expecting to recoup. Trade payable, what we need to pay to our creditors, No, that's not an expense. That's not an expense. That's a liability, a current liability that we need to pay out. But that's not what we call an expense. Repairs and maintenance, yes, that's an expense. Rent expense, not rent, but rent expense. Water and electricity, that's an expense. Um, Interest on fixed deposit. Interest, actually, it's an income. We are getting, if we are paying, out an interest, so this is an interest that we are paying out, and then if we are collecting interest on a fixed deposit that we have put in the bank, that's an income to us. Taxation, expenses, advertising, advertising, not an expense because we're not expecting to get it back. If we've paid to advertise for something, we're not going to ask that money back. Telephone is an expense. Trade receivable, what they owe us. Somebody owes us something and is repaying that. That's not an expense. Credit losses, cost of sales, and stationery. Stationery is an expense. Stationery is an expenses. Is an expense. Um, and and also when you look very well, credit losses is an expense as well. Okay, so now when we look at interest, you need also to see this item called interest on your income statement. And I will come back to an example of an income statement. So just stay with me. Just as you are reading, you will see also that, and I want you to make a difference between an interest income. I mentioned that already. An interest income, this one, an interest income, and an interest expense. When you're looking at an interest income, it's an interest on data overdue accounts or favorable bank balance. If I have money and I'm getting some interest on my saving accounts, uh, or interest on a fixed deposit or other investment. So I invested into something and I'm getting interest from that investment. That's we call an interest income. And an interest expense, it's the other way around. It's money that is going out. Let's say maybe an interest on a loan. I took money from the bank and I need to pay interest. That's an interest expense. An interest, and I repeat again, an interest expense on our income statement. You need to make a difference between an interest expense and an expense for the business, and a marketing and selling expense, or general and administrative expense. So I will make it clear the difference to you. The difference is that this is a financial expense, and the normal expense is either a marketing and selling expense or a general and administrative expense. I trust that that is clear to everyone. All right, so now the good thing is we have few items here, and let's deal with a particular income statement. This is a statement of comprehensive income from Wannabe Rich. As you can see there, traders of the year. Right, so we have here uh, that 560K.